And let's bring on board Aishwarya Dahadij, the founder and CIO at Fident Asset Management put together. Morning there. I hope you've got your name pretty right. Apologies for the error, if any. But I'd like to start off with what do you make out of the current market situation that we're looking at? A bit of correction that came into the markets yesterday. 1.5% was lost, and it was not even just a day. It was just 1 hour of profit booking which took place. You think it's just a temporary blip, or you think there is further amount of weakness which is expected to creep in?
Good morning, Nikki, and good morning to all the viewers, and thanks for having me here.
Pleasure.
Obviously, it's a tricky week. We saw, as you said, that there was a sudden, decline in the market. We witnessed it in India. Even yesterday night, we saw the same thing happen in USA. And possibly the scare it's kind of profit booking, which got accentuated because of, the COVID scare when we heard about cases in Kerala and Karnataka coming up, the new variant. So more than that, if we look at it, is more of a profit booking. So if you really see, Nikki, that mid cap and small cap, which burnt the highest, investors' wealth yesterday, even after that, I would say mid cap is up more than 35% so far in this last 1 year, and small cap is still 40% plus for the last 1 year. So I believe for investor, it is just a blip. Obviously, as we have highlighted earlier, the valuation of mid and small cap are not comforting. Rightly, we will enter the next quarter in couple of weeks, and it is very important that fundamentals get support by better results to justify this kind of valuations which are there. I was looking at this data, which we normally track is, the market cap to GDP. And I was surprised and want to bring to everybody's viewers interest is that if you look at the small cap and the mid cap, market cap compared to our GDP, they are inching to a 25% and 20%. Mid cap is almost hitting to a 25% and small cap at 20%. They are almost in line with what we saw in 2007, right? Obviously, we have fundamentals intact over there that if you look at from 2023 to 2025, the earning growth expectations of mid cap index and small cap in the range of 25% and 30%, right? So those valuations can to an extent be justified by this kind of earning growth, but definitely there's a lot of froth in many of those sectors. And I would advise investors to be cautious going ahead. For yesterday, I strongly believe it is more of a consolidation. I believe this is a healthy consolidation. If you are an investor, it should not worry you much. But if you are not an investor, this volatility will stay here for the coming weeks.
When you say coming weeks and you advise a sense of caution, this is particularly for large caps or mid caps. Do you think yesterday that we saw was a normal profit booking, at least when it comes to the small cap space, or it indicates a change in market momentum?
If you look at this last, 7 weeks when the market really jumped up, so fiercely, and even in this month of December, what is important for us to know that actually large cap has outperformed mid and small cap so far in the month of December. And we should also know that this is a lull period where majority of the people go for vacations, and even the participation of FIs is, relatively limited. So in these scenarios, the HNI plays an important part. And whatever we saw yesterday was kind of a profit booking which happened more in mid and small cap compared to large cap. So as earlier indicated, we believe large cap is somewhere people should start shifting their earned money from here onwards, and this trend is expected to continue, in my understanding.
Well, point well taken.
That large cap will continue to outperform mid and small cap at least large part of December and January.
All right, point well taken there. But let's also talk about IT stocks per se. A bit of weakness is finally seen, or let's just say a little bit of weakness is seen in today's session. We've seen some amount of traction building up in the names thus far in the week. Accenture's weak outlook also did not ruffle much feathers around. What do you make out of IT sector right now, and which are the stocks within the space that you like, and why?
Right. So obviously we saw what Accenture reported, and they were. I won't say that Accenture was a completely washout. If you look at their bookings, both consulting and outsourcing, as well as the employee addition, and obviously the demeanor was that the guidance for the next quarter was kept in the range of -2 to +2 compared to what 0 to 4% expectations which were there earlier. But the clear trend of strong bookings, strong deal wins and possibly revival by half of first after the first half of calendar 2024 possibly is giving us a signal that all that is not bad in the IT space in US. So back home again and again because of this, I would say the couple of quarters might look bad. This is a washout quarter, seasonally weak quarter, and we will expect that it will be extension of what numbers we saw last quarter, and this weak set of numbers will roll out at least for 2 quarters in my assessment. But the strong set of economic data which we are witnessing in US and revival in Europe over the last 2 3 quarters, we believe that possibly by end of FY20 calendar 2024 we will see some strong revival in the IT revenue side. If you see the last 2 quarters, we have seen strong deal wins across the board, whether it is large cap, mid cap, and small cap. So there has been a lot of leakages happening. Deals are not being converted into revenue over the last 2 3 quarters, but that trend should unwind in the later part of calendar 2024. On top of it, Nikki, we have also seen that the US US 10-year has gone below 390, is close to 385 today. That will also provide support to technology stock. So all in all, I believe it could be remunerative for someone to go long on large cap ITs, right? Because in mid and small cap ITs, we are seeing that valuations are really stretched, given the context. So I see a lot of valuations comfort in large cap IT, and I believe that is the 4 5 names where you have comfort on growth can possibly give you 15 20% return for the next 2 years compounding.
Okay. So, top two picks within the space?
As far as large caps concerned, we like that. TCS is one name which is very. If I just look at the deal wins that they've gone in the last 2 3 quarters, I believe TCS should be a good buy at these levels. And in mid cap side, we have a lot of comfort on play like Persistent. Obviously, valuations are a bit stretched. And even in play like Emphasis, if you see the last couple of quarters, there is a clear trend of revival happening both on margin and growth. So those would be the names which possibly could create a good, compounding story for the next 2 3 years.
I want to chat with you about Moscow Dockyard and Cochin Shipyard. These are apparently the two names which have, one of the buzzing counters in today's session. We've seen some traction there on account of the order win that's coming from the defense space, of course. With what has been done, with the wealth that has been created by Moscow, what do you think the valuations look attractive at this point of time? How are you approaching these two counters?
So obviously, if you look at this particular segment, the kind of order win intensity which has been witnessed is phenomenal. And with the current government focus, we believe this order continuity will be the trend for the next 2 3 years. Given the government continue after the general elections we have in May. So from business perspective, from companies revenue, EBITDA growth perspective, operation perspective, things are pretty solid. But on valuation side, we at Fident are not very comfortable given the rally that we have seen in stocks like this. So I would advise investors to be cautious because in this kind of company, it is very important that valuation go in sync with the fundamentals here. So, obviously we have a support on I would say, the operational parameters, but there is little left on the table for investors because the runway that has been very steep. And we at Fident are not very comfortable to get into businesses where valuations are so stretched.
All right, that's the word coming in. Of course, we are also wanting to talk about BSE and the other exchange-related stocks. Like BSE more so from a point of view that there is a new chairman at the helm, of course, What do you make out of exchange related stocks, and of course now BSE also, which has gained significant amount of momentum? Derivative segment is yet to pick up pace, but we're seeing additions now incrementally happening even towards NSE, which is adding to that pool. How do you see that shaping up in the near term future for BSE?
BSE has been one of the biggest wealth creator for investors over the last year or so. And the kudos goes to the management where they've been able to ramp up a lot of those derivative-based platform, and the operational parameters has been nothing less than miraculous. And that's why if you look at the valuations has a lot of support from the fundamentals which has been derived. Right. And if you look at the PAT growth for the next 2 to 3 years, the street is very, very positive on their outlook. And obviously, I always say that this kind of businesses are quasi monopolies. There are just two players in this segment, and we as India's ecosystem from that side, I think these two players will meaningfully benefit out of the whole shift of economic growth and even the market cap addition that will happen over the coming 4 to 5 years. So we are very, very positive on exchange related, whether it is BSE. Obviously, NSE is due to be listed. But we see this space very, very attractively. Obviously, BSE valuations have got stretched a lot, but we believe that the earning momentum is in sync with what the valuations are. So investors can stay put into the names of this BSE. And obviously, the additions to the management team, I believe it's a welcome change.
All right, that's the word. Apparently, Oil India, ONGC, these are also some of the counters which have been doing extremely well in trade. Oil India at least was at 14-year high. In light with what's happening across crude oil and the worries that we're looking at, how are you approaching this space now?
So if you look at in the last, since September, crude oil is roughly down 20%. Right, and we have seen that it has benefited all of these OMC players, and the rally we witnessed into these kind of players which you highlighted. But going ahead, given the strong US economic data revival in I would say European side, and we are hearing about teething issues in the Red Seas and the Suez Canal and things like that. The possibility, and possibly we obviously the drag has been on China growth, but if we see some large impetus been announced in China, possibly we are closer toward the bottom of the crude prices. So in my assessment, crude should either stay here or they should go up in the range of $80-85. And we have to look at from that perspective that if that stays in that range, the upstream companies as well as the downstream company will have to be act accordingly. So we normally at Fident avoid these kind of businesses because of both macro commodity related risk as well as the government risk. But the rally that we have witnessed is more or less, I want to say, has been factored into because of the decline in crude prices, especially for the oil marketing companies. Going ahead, it will be tricky because if crude swings back, obviously we will see that that auto fuel related things will start impacting OMCs there, and possibly that rally can get some sort of jolt going ahead. So we are watchful about crude prices, but I would believe that large part of the rally more or less has been done in this kind of sectors.
What do you make out of Inox India also? Because that's an issue which is going to be the IPO, which is going to be listed today in some time now. Experts around the corner are expecting a 75-80% kind of premium coming in on this one in a market weak market like this as well. It's a complete OFS offer with no listed peer group in India whatsoever. What do you think about it?
No, I seriously believe that there is a craziness in your SME IPO market, and even in the main board IPO market. We saw a lot of good companies getting listed. Yesterday we saw DOMS, had a very good listing. And obviously, as you said about Inox, this is one business which has a very limited, I would say, similar peers. And being an OFS, we believe the interest will not dilute much even in this weak market. So I believe these companies will obviously have a good listing. And we are seeing a plethora of IPOs coming over the next month or two. And many of them are very, very, I would say, attractive businesses. But we normally, at Fident, we normally stay away from IPOs. We believe that valuations in that particular segments are not very, very attractive for investors to compound money from 3 year perspective. So, that is time we remain very judicious in our assessment of identifying great businesses in sync with valuations.
All right, Aishwarya, I was just going to leave it at that. And thank you so much for offering that perspective to us.
Thank you so much. Thank you so much.
All right, that's all that we have. Inox India is apparently going to be listing in today, so do keep an eye out on that one after the phenomenal gains that we've seen for DOMS. It's the largest supplier of cryogenic equipments in India with no listed peer, debt-free company with revenue growth of 25 to 30 odd %. Need for visibility essentially in export market makes the company go public and today get listed. Okay, with this, it's a wrap and goodbye from the entire team who puts this piece together. Now, thank you for watching and please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned into moneycontrol.com and Money Control app.